Hey, it's Mark from Caliber Home Loans, and I'm going to work through the mortgage market over the last week and all the way through the last month. And then we're going to take a look at where we're at since March. So this is the week ending September 18th. So let's go ahead and get started. So this is today's chart. So again, this is the bond pricing, and remember that bond pricing moves in the opposite direction as the bond rates or the bond yield. So we lost a little ground, especially towards the end of today, which caused most lenders to reprice for the worse. So pricing got a little bit worse actually about an hour ago. So about 4 o'clock, our pricing got a little bit worse. But it's been kind of a downer week as far as the bond market. So let's take a look at the week. You can see that we started up here, and we're going to end up right about there. And so again, price is dropping, so the rate goes up. Now, it's not quite as bad as it looks because you got to look at the gap. It lost about a half a point in pricing, so it did push rates up a little bit. But we're still quoting rates for those that have good credit, under 3% on a conventional loan. So, we talk about this every week, and it's just I keep coming back to the same conversation that even though the market fluctuates, and sometimes it's good and sometimes it's bad, generally speaking, we've been under 3 for a long time now. So it's good news for people buying homes and for those that are looking to refinance. So let's go ahead and look at the last month. So you can see that, kind of a dip in the price on the August 27th, which pushes rates up. And then it kind of peaked right around September 3rd, which pushes rates down, and then it's been kind of on a free fall. And this has been caused by a lot of factors. But remember, we talked about one of the prevailing issues with bondholders and bond investors is the anticipation of inflation. So good news on Main Street is inflationary. So that means that good news on Main Street is bad news for bonds, because bondholders and bond investors, if they think there's future inflation or inflation is going to go up, they're going to want a higher yield. They're going to make more money in the bond. They're going to force the yields up and the rates up. So this week especially, so some news came out as far as consumer spending and retail sales that was a little bit higher than expected, which is good news for Main Street. It's good that people are out spending money, but not especially great for bonds. And then a week or two ago, the Fed changed the way that they look at inflation. They used to have a hard stop. They didn't want inflation to go above 2%. But then they changed and said they would deal with it if it averaged 2%, which means they'll allow inflation to go above 2% to get to that average. So again, bondholders aren't real crazy about that idea because they want to increase their yield if they think that inflation is going to rise. So let's go ahead and take a look from March. So again, we can see that there's a dip, in May, April, May, June, and then it started to climb a little bit. But all in all, because the Fed is still in there buying bonds to the tune of millions of dollars a day, so they're buying bonds for FHA, VA, rural development, which is the Ginnie Mae bonds, and then the conventional bonds, which is Fannie and Freddie bonds. So they keep spending all this money buying bonds, which is keeping the pricing relatively flat and keeping mortgage rates low, which is what they want. They want the housing market to keep cranking along because that's the one really bright spot. And people who are moving or those that are renovating, they put money into the economy because they go out and buy stuff besides the house itself. So for next week, the weekly jobless claims will come out on Thursday, and the new home sales will also come out on Thursday. So those are kind of the biggest reports that are coming out next week. So anything that's inflation related is going to push bonds around. So the other thing I want to remind you is that, I know first-time homebuyers just have a hard time collecting enough cash to get to the down payment. So as you know, I do a lot of MSHDA loans using the down payment assistance program. One of the things that most people don't realize is you can actually pair a MSHDA down payment assistance with a rural development. So in the right circumstances, basically they come to the closing with 1% of the purchase price and they're pretty much done. Because in a rural development, there is no down payment required. And if the appraised value is over the purchase price, we can roll in closing costs. So, they have to have the 1% based on MSHDA rules, but it's a great way to go. So if somebody is near the border, and in the email I included a link to punch in an address to see if it qualifies for rural development. But if they're close to that border, if they just move into the rural development area, they can save a lot of money getting into a house. So give me a shout if you need anything, pre-approvals, any questions in general on the market, or if your clients have any questions, give me a holler. Have a great weekend.